it was put under liquidation following U.S. decisions, the financial crime network, FinCEN, decided that this is an institution of money laundering concern. So following that decision, we in Tanzania also, the central bank decided also to put this institution under liquidation. And I'm saying this institution had a branch in Cyprus. So why we delayed that much? Because we are talking of 7 days, or at least shortest period of time. Number one, and this is the experience I want to share with you, we faced problem with ex-staff. There was staff from, foreign staff employed by the Cyprus branch who was the IT super user. And so for some of us who are in the IT, they will know what that super user means. That means this is the guy who can allow others to operate the systems. So this guy went into boycott and took us to court, complaining some of this that there are some rights which he didn't get from the Deposit Insurance Board, and the result, we couldn't access the information in this particular bank. So times went on, and we say we cannot hang around without paying depositors because that is our responsibility. So 6 months after the closure, we decided to use the physical mandate files. So you go to the physical files, physical information that we can access, and make payment to the depositors. Definitely, you will have the report of the balances from Central Bank of Tanzania as on the closure date because they are the supervisors. But then verification of the people and all this, with the system you can do it very quickly because you just punch on the computer and they give you the picture, and give you the information of the depositor. This time it was difficult for us, so we had to go through physical verification. So it took time to make that preparation. That's why it took us some. As I shall talk later on, we need to be very smart in handling labor issues when it comes to liquidation of banks because of the problems we faced in this particular bank. I'll talk it later on. Now, in paying this, we used our own staff. We are very few, but we got support from the Bank of Tanzania, and this is another advantage I would like to share with you when we are talking of payables. If you decide to go payables, as the previous speakers and others have said, it may make sense to be in the central bank because you need to build up experience. At the times, like I said, you use facilities of the central bank, but in payout now, this bank had 5 branches. 1 in Cyprus and 4 in Tanzania. And we were 11 people in the Deposit Insurance Board. How could you manage that? So we relied on the Bank of Tanzania. They given us supportive staff. So we managed to pay out people in this particular bank using the support of central bank. So as you start, my colleagues who are thinking of having a deposit insurance system in their own country, it is sometimes it pays to be in the central bank. Maybe you don't overstay there. That was one bank. Again, 4 days left thereafter, the central bank put another bank under liquidation. This was a small bank known as being a community bank. In this case, our payout commenced in July, May to July. So at least here we used 2 months to pay. Why again? This was a bank located more than 1,000 kilometers. My country is bigger than Uganda, and bigger than Uganda and Kenya together, and bigger than Uganda, Kenya, and Rwanda together, and bigger than Uganda, Kenya, Rwanda, and Burundi together. So this is located far from our head office, more than 1,000 kilometers. And as I say there, we had depositors scattered in a very, very wide area of that locality they are operating. So again, we collaborated with another bank known as Tanzania Postal Bank, whereby DIB now, I'm talking of a shortage of staff. So we put the infrastructure in place and we said we are going to make payment to these people. And you, Postal Bank, Tanzania Postal Bank, nowadays they are known as TPB, please help us to handle the cash aspect. So the cash, whoever wanted to be, because we had the option, one can come for cash, or one can come for transfer to another bank account. So that aspect was managed by another bank, while the verification aspect was done by deposit insurance. So we verified. Once we are satisfied, then, because for you to qualify to be paid, you have to come with a set of IDs, including the bank one, and of course the national ID and the other IDs, plus filling in a claim form. You have to fill in a claim form. So once somebody has filled a claim form, we verified, and once we are satisfied, then he crossed to another a window there where he was paid. Let me share experience on this one as well. As I said, people had the option of cash or transfer to another bank account. But we are strict when it comes to groups. In this particular bank, there was a lot of groups that had an account in this particular bank. So operators groups, there was a benefit, and I think it was a product designed by this liquidated bank that if you want to access a loan here, please go into groups, and then, so when it came to groups and the other companies and the other claimer, other depositor other than a natural person, that means a human being, we requested them to transfer to another bank. So the groups, we didn't want to kill the groups because it is the bank who died. But the people are still there. The interests are still there. The economies they are running are still there. So for us, we convinced them to open another bank account so that life goes on. So this is what we did in the Mbinga. So we managed to transfer a lot of groups to another banks of their own choice, instead of closing their, because there is a danger also of giving cash to a group, because they have got their own financial regulations on how they manage cash. So we didn't want it to be part and parcel of the legal issues that will follow thereafter. So that was one, but more important was to make sure that people's lives keep on. Okay, as if that is not enough, 1 year after, on 4th January 2019, 5 banks were put under liquidation by the central bank. Thanks to God, the 2 exercises served as a pilot projects. So on 4th January 2019, we had another 5 banks closed, and the names are there. And the main reason was that, of course, some were poorly managed, but the main reason that central bank gave is that they managed to raise the capital to the prescribed limits by the central bank. So for the 5 banks, we commenced, which was closed in January, we commenced to pay out in March. So again, 2 months after the closure. You see, it's a small group of people, of only 11 people, paying out to 7 banks, and again given liquidation mandate to liquidate 7 banks at a time. This was a big job, but thanks to God that we managed to handle it properly, and there was not much complaints from the depositing public. So, which challenges did you face? Because I'll leave you to answer, to ask me questions if there will be. Number 1, payout exercise. This was the first ever test to us. We started in 1994, long years ago. So like after 22 years, 23 years, then that's why you are tested now to start making payout. I did say about the distance of this bank. 3 banks were very far from our head office in Dar es Salaam. So that was the first challenge. Again, another challenge was the learning curve. How do you manage the exercise? How do you, and this majority of these people are in the rural area. Funny story I would like to share with you here also is that when we moved to these banks in the rural areas, some people were coming with money to deposit. Exactly. So you go there to start paying out, but depositors are coming with money. That tells us what, as depositors? Number 1, these people are very loyal. They rely on banks very much. They have so much trust with banks. that my money is in safe hands. So having the deposit insurance system in place is a very important thing if you are taking into consideration those people in the rural areas. I believe we are coming from Africa. We have our rural areas. So those people don't know much about the affairs of the banks that are depositing their money in. That's why while we are preparing ourselves to pay out, some people are bringing money. That is one lesson that we need really to protect them, because that money means a lot to them. But again, they don't have the information. So public awareness, again, is an important aspect when you are running a deposit insurance institution, because people need to know that they have to know the banks they are banking with, because at a time a bank can fail, because failure is part of the market process itself. But again, this is meant they need to have a deposit insurance system, because those people in the rural area really they are so innocent, so to speak, with the system, the banking system, such that they don't figure out that a day will come when that particular bank is closed. Number two, the challenge we face, incomplete KYC, know your customer. So you go somewhere, you want to make payment, but the picture is not there. The contacts are not there. These are rural banks in the rural areas. So it was a big challenge to us to start to go back into the mandate files and establish whether we can have the information that you need to start making the payment. So for us in the deposit insurance, whom we have the opportunity of supervising banks, or at least going for on-site examination, an important area which I suggest you should look at and put most emphasis is on the KYC compliance that you must have. I understand some of us, the previous speakers have talked about a single customer view system, very important. But before you have a single customer system, a single customer view system in place, then you need to make sure that KYC compliance is 100%. Because if you go for payout and the information is incomplete, you cannot exercise your duty of being of paying out the depositors.
Try to get my slides moving. Here we go. First, I'm going to talk about basically what is a loss minimizing deposit insurance system. You heard about risk minimizers before, and Paybox Plus and these types of things. Then I'll look at some of examples around the world, and then I'll talk about a case study of CDIC, and then I'll end the discussion with, at least in my own view, what are some of the success factors for developing a loss minimizing system. Okay, I got the hang of this. Here we are. We put these definitions up before, and I think one of the things to say about mandates is that for simplicity, we've classified all these deposit insurance systems into 4 categories, but that's somewhat arbitrary. Really, mandates are a continuum because there's so much overlap in what they do. And in particular, when we took at loss minimization, here we define it as a loss minimizer mandate is where the insurer actively engages in a selection from a least cost resolution strategy. So the assumption is it's a resolution authority. It has this full suite of resolution powers. And it doesn't do much else. It doesn't move into areas such as supervision or into intervention that much. But the reality is there's sort of a very fine line between loss minimizers and risk minimizers. And we know this because in the IADI survey, we ask all the deposit insurers, define yourself. And this is one area where we see back and forth. 1 year, a deposit insurer defines themselves as a risk minimizer, one as a loss minimizer. And so this shows that there's not the clearest distinction. But one of the key aspects of a loss minimizer is that they're in their mandate or in their objects, they have to minimize their costs. They have to have least cost type of a vehicle there. And usually that requires them as a resolution authority to implement the option in resolution, including liquidation of a failed bank that ends up in the least costly to the authority, the financial system, or the deposit insurance system. And this is where it gets a little tricky because it's these distinctions, least cost to whom, under what circumstances. And so that's where we also see a lot of diversity in the system. Some it's the least cost to the insurer. Others have a wider mandate, least cost to the financial system, which is often more difficult to achieve. So this is, again, some of the challenges in these areas. We've gone over this a number of times in the presentations the last few days. There's no single mandate for all insurers, but a key issue here is the mandate has to support the public policy objectives and be clearly defined and formally specified in legislation. This is absolutely critical for a loss minimizer because the deposit insurers who do loss minimization and risk minimization are working much more actively with the supervisor and the central bank. They and sometimes even have complementary powers. So coordination is more challenging in a system like this, and clarity is extremely important for mandate and power definition. Okay. Again, we talked about these minimum powers. Loss minimizers have all of these, but they also have additional powers and authorities. Okay, I'm trying to... Here we go. When we look at classifications of systems that are in existence, of the 135 deposit insurers or so, about 28% are what we would call loss or risk minimizers. They are all over the world. They're not just in certain continents or areas. And we have quite a concentration of them in North America, for instance. We have Canada, which is a loss minimizing system. We also, in Canada, to complicate things more, we have a lot of provinces, and some of these provinces are structured almost as their own national entities with their own financial systems. So, for instance, in the province of Nova Scotia, they have a credit union deposit insurance system where the credit union credit union insurer is the resolution authority and has a wide range of powers and even does supervision over their credit unions. So they're classified as a loss minimizer. Colombia in South America is probably one of the most well-known in that region, and Fogafin has really become the primary resolution authority there. Europe has them. Croatia, France, and Italy are all loss minimizers. Indonesia is quite significant as well. They are a loss minimizer. They actually almost verge on the risk minimization system. But as you can see, there aren't that many, and I think one of the reasons is that most loss minimizing systems have evolved over time. It's actually quite rare to see the introduction of one right away. We talked before about how this works when you set up a new deposit insurance system. Often they're pay boxes or pay box pluses, and it's generally over time and experience in using their tools that they accumulate different powers and authorities. And this is often the case here with these loss minimizers. You've seen this before. This shows the trend over time. There's been a slow increase in them, particularly since the global financial crisis, because governments have found them useful. It's useful to sometimes package basic deposit insurance with resolution powers, so they've done that. We also, when we were collecting these numbers, we did some number crunching, and it was interesting to look at some of the relationships. There was a direct relationship between the extent of an insurer's mandate and how long they've been in existence. Virtually all these loss minimizers have been in existence for over 10 years, some of them 20 or 30 years. And again, we attribute this to an evolution, not a revolution in terms of mandates. Best way to describe what a loss minimizer is to actually see one, and CDIC Canada is a good example. CDIC has been around quite a while, since 1967. It's got a pretty simple mandate, but its objects are, I think, the interesting thing to look at in terms of it provides insurance against loss of deposits. This is common in most systems. It's supposed to promote and otherwise contribute to financial stability. Again, pretty common. But the third one is the key here. CDIC is mandated to pursue its objects for the benefit of depositors, to make that very clear. It's not there for banks, it's not there for the government, it's there for depositors, and in such a manner as to minimize CDIC's exposure to loss. And there used to be a period right after exposure to loss, but in the global financial crisis, the federal government added in something else, and a lot of loss minimizers have this, and that is, we would call it a systemic bank exemption, or a systemic bank provision, and that's what the little note says. And in very quiet language, the statute was amended to say that CDIC may seek an exemption from this loss minimization mandate, or could be directed to act without consideration for their mandate, where the situation might have an adverse impact on the stability of the financial system in Canada, or public confidence in that stability. And that came out of issues that happened in the global financial crisis. Luckily in Canada, no banks failed in the crisis, but many of the big banks, the systemic banks, had problems raising funds, and the government created a special funding facility for them. And it became very apparent to the government that through a combination of policy and luck, Canada avoided a major systemic bank failure. But when they looked at CDIC's mandate, they said, well, in some of these systemic banks, to minimize CDIC's exposure to loss, you actually would have closed them because they didn't have a large amount of insured deposits, or it would have been cheaper than the other alternatives. So they put in the systemic bank exemption, we call them, and a lot of countries have these. The US has them, and I think if you have to be very careful with them because there's always that temptation to use them for other banks. But so far it hasn't been used, but it's been added in. CDIC is a crown corporation. In Canada, that's basically a government agency. They insure deposits up to $100,000. There are 85 member institutions. There are not a lot of banks in Canada. There's 6 domestic systemically important banks and a lot of small institutions, but a pretty sizable deposit base. And also, it's a pre-funded system, and it has some extensive emergency liquidity provision. I think other elements in the loss minimizing mandate that are worth mentioning is CDIC over time has developed a risk assessment capability. It's called an off-site risk assessment. And it also has certain intervention powers. They're not as many as the supervisor, but they are intervention powers, and a lot of deposit insurers don't have them. And a lot of resolution tools. There are 6 domestic systemically important banks, but one of them, Royal Bank of Canada, was just designated by the Basel Committee and FSB as a GSIB. So that's been quite a development for Canada. Canada now has a GSIB. This Paybox Plus mandate was what we started with in about 1967, and in 1987 to 1992, we got an accumulation of additional resolution powers to make us a loss minimizer. And in 2009 to 18, right after the financial crisis, the government reevaluated CDIC again and gave it direct authority over systemic banks. Prior to 2009 in Canada, when there was a bank failure or a trust company failure and it was small or medium-sized, that was viewed as the territory of the insurer and the Insurer Resolution Authority. The systemic banks were always looked at a little differently, and they viewed the supervisor and central bank together as the potential resolution authority. But they realized after the global financial crisis, it would probably make sense to change CDIC's statutes again and make them the acknowledged resolution authority for all banks and give them appropriate tools. So that's what they did. This shows the evolution. People say, how does this happen over time? These are sort of key dates and when key powers and authorities were given to CDIC. 1967, we started out really as a pay box. In the 1980s and early 90s, we had a wave of bank failures in Canada. Most of them were banks or what we call trust companies, which are deposit-taking institutions like banks. And we had actually over 43 institutional failures between about 1980 and 1996. This was not systemic. These were not very large institutions. But of course, it shakes up the system when you have lots and lots of these failures. And this really shows lessons learned from mistakes made in failure resolution. When the first wave of failures occurred, and parliamentary reviews went after them, we realized that the system needed changes and the insurer needed more resolution tools and how to use them. And that's basically the way CDIC has evolved into this loss minimization system. There was a need in '92 when we had a specific failure that if we had had a partial recapitalization tool, that would have saved a lot of money. So that was added to the statutes. In 1996, they gave CDIC a sort of a pseudo bridge bank power called a financial institution restructuring provision. It allows the corporation to temporarily take over, vesting the assets or the shares of an institution in CDIC. It's almost like an expropriation. And this was a power that was felt the insurer needed, and it was never used but threatened in a number of cases where the owners of an institution were reluctant to reach a non-payout resolution. And this was used to encourage them to do a deal, and it became very, very useful. And it also became sort of a power you have in the back of your pocket if you need to temporarily take over an institution where you can't liquidate it, you can't find an acquirer. In 2009, we were given formal bridge bank authority where we could basically nationalize a distressed institution and for a 2-year period run it as a bridge bank. We basically copied the FDIC legislation in this because it was right around the financial crisis and we realized that we needed some type of tool to deal with a systemic bank, however imperfect. In 2010 and 15, we were also given additional powers because CDIC was required to develop resolution plans for the systemic banks and also needed to share information and require information from those banks to do resolution planning and mandate resolution planning, and they added a systemic override provision. And the last set of authorities was in 2016. And for those of you aware of the Financial Stability Board's key attributes, their requirements for bail-in and their total loss-absorbing capacity requirements from the FSB. So Canada adopted those for its GSIB, but also its 5 other systemic banks. And basically that's the bail-in provision. We require our banks, the systemic ones, to issue bail-inable debt. We have a framework where in the event of non-viability, we would convert this bail-inable debt into equity into the bank to recapitalize the bank. And that would also include CDIC taking temporary control of that bank and restructuring the bank and returning it back to the market, effectively recapitalized and restructured. This was very complicated doing bail-in regimes. And it's a power that is still somewhat controversial. A number of you were at a meeting we had in the IADI and the BIS a few months ago, and there was a view that bail-in was an the development of a bail-in tool and loss-absorbing capacity was a good thing, but it shouldn't be just relied on as the be-all and end-all of large bank resolution. If you have a number of large banks failing at the same time, then bail-in all of a sudden becomes a very difficult tool to utilize. And there was recognition that bail-in may not be appropriate in all countries, particularly if you have banks, large banks that are primarily funded by deposits. That means there's not a lot of bail-inable debt. And certainly, as we saw in Cyprus, the last thing in the world you want to do is try to bail in insured depositors. And even bailing in uninsured depositors creates risk. So it took over 2.5 years to develop this very complex legislation for CDIC. Here's a slide that just shows you where CDIC is in the Canadian financial system. In Canada, we have a federal government and 10 provinces, and it's a very loose confederation. Some of our provinces are almost like separate countries, and they have separate systems. So there's a federal system and a provincial system. So one on the left and one on the right. CDIC operates in the federal system, which is about 90% of the assets of the system. And CDIC is, it shows you that in Canada, every function is almost done by a different organization. It's just the way the system evolved. We have the central bank, Bank of Canada, But they do monetary policy and oversight of the payment system. They're not really involved in any way in bank supervision or anything else like that. We have the Superintendent of Financial Institutions, that's our supervisor, OSFI, and they supervise federal institutions, but they also, bank institutions, but they also do pension plans, they do federal credit unions, and they're really CDIC's key partner. We have a financial consumer agency that's market conduct and consumer protection. And then we have the Department of Finance. And the Department of Finance is like the referee of the system. They look over the development of policy and they help with the coordination mechanisms of everyone. People talk about operational independence. CDIC is quite operationally independent because in the statute, CDIC reports to Parliament through the Minister of Finance, but it doesn't report to the Minister of Finance. So we're not a department of the Ministry of Finance. The Superintendent is effectively a department. CDIC has its own board and its own governance requirements. And so this has been very, very helpful in terms of limiting political discretion in the system and in resolution. We have a board of directors. We were talking earlier about board structures and how you set them up. CDIC, there's 11. We have the chairman of the board is always an independent private sector person. Now, they can't be bankers, but they're often retired financial professionals. The current chairman of the board is a retired banker and used to run a law firm. We have 5 ex officio members. So we have the governor of the central bank sits on our board. We have the head supervisor and their assistant. We have the deputy minister of finance, the financial consumer or the consumer protection agency head, and 5 other private sector directors, so independent directors. So the 6 independent directors actually exceed the ex officios. And this was set up because they didn't want government entities in any way trying to dominate the board. They wanted them to have a key role, but not be in a majority and try to dominate. So this is the structure CDIC has had for a very long time, and it's actually proven, I think, highly successful because the independent board members bring a different perspective than the ex officios. As we know in governance, board members are supposed to look at the best interests of that organization. They're not supposed to wear lots of different hats, but the reality is they do. And this is a bit of a check and a balance on that in CDIC. We have a lot of formal information sharing and coordination, but it didn't start out this way. It started out with informal mechanisms, and that was quite frankly a mess. As more and more institutions joined the Canadian financial system, these informal relationships between the supervisor and CDIC and the bank didn't work. When there were problems, information wasn't shared. This delayed resolutions, it added to costs. So they set up a variety of mechanisms. For instance, the supervisor runs the Financial Institution Supervisory Committee. It's chaired by the superintendent. Their job is they meet almost about every 2 months, and what they do is they look at the health of the banking system. He gives a presentation on all the institutions, or peer reviews of the institutions. They talk about the risk assessments, potential problem institutions, that sort of thing. And CDIC is a part of that, as is the Bank of Canada and the other agencies. We have a senior advisory committee, which is run by the Department of Finance. That's macroprudential policy. Again, all the key safety net partners are there. We have the CDIC board. And then I'll speak to this a little bit later. We have an OSFI CDIC guide to intervention. I talked a bit about membership and coverage, maybe a little more on coverage. CDIC insures up to $100,000 per depositor per member institution. A wide range of accounts are covered. We cover separately retirement accounts and joint and trust accounts in that. Even though the limit is $100,000, a savvy depositor, through using different accounts, can leverage up their coverage quite a bit. So when we compare ourselves to the US or other countries, it seems like our coverage is much lower. But effectively, if you use all of these categories, you can get up to 700,000 Canadian dollars in coverage from CDIC. Risk assessment, we don't call ourselves a risk minimizer, but CDIC has risk assessment tools. One of them is called the Policy of Deposit Insurance, and that is when CDIC was created and the banks became members, all the banks had to sign a bylaw, Policy of Deposit Insurance, which explained to the banks what the expectations and requirements of CDIC were, the provision of information, the payment of premiums. And the policy is a very useful tool because just like in private insurance, it gives them the terms and conditions and also what can happen if they don't pay their premiums or if they're non-compliant. We have CDIC bylaws. They look at everything from coverage to deposit, the differential premium system, a wide range, even the bail-in. The bail-in comes as a bylaw and a regulation. The supervisor does its regular risk assessments of our member institutions or CDIC's member institutions. CDIC has an off-site risk assessment tool, or it's actually a department, where they collect the information from the supervisor and sometimes do their own risk assessments of institutions. Because as an insurer, you're going to look at an institution a little bit more differently than a supervisor. We're going to put a lot of attention on the liability side rather than the asset side. And so this has been quite a useful tool for CDIC, and there are regular meetings with the supervisor, and also a lot of sharing, and it's written in everyone's law. In CDIC's Act and in the Supervisor's Act, there has to be a free flow of information given with confidentiality. So all the risk assessments a supervisor does are provided to CDIC. And it didn't used to be like that. It was part of the reforms in the mid-2000s where that occurred. CDIC also has what can be considered intervention tools. If there's a problem institution, CDIC can require undertakings. It can conduct preparatory and special exams when an institution is approaching non-viability. And then what's very interesting here is CDIC has the ability to terminate membership. And this is different than closing a bank. This is different than revocation of a license. The supervisor revokes the license, and typically that is done, and then there's a termination of insurance. But there are cases where the CDIC could propose terminating insurance if there's an issue or dispute with the supervisor. This was done as a check and balance in the system. It's never had a situation where the deposit insurer withdraws deposit insurance and then the supervisor allows the institution to continue to operate. But it was done because there was a sense in the 1990s that there needed to be a check and balance on potential forbearance. So that was put in there. CDIC does its own risk assessment reports, which we coordinate with the supervisor, and they have a watch list and an annual membership review. This is just a reminder, there were 43 member institution failures since 1967. About half of these were purchase and assumption resolutions, but about 22 of them were actually closures and liquidations. And while there is always this preference for doing a P&A transaction because of the benefits we talked about earlier, where you keep the institution or at least the accounts open, you just transfer the deposits. There's less disruption, and that's always what you're aiming to look at. You're always trying to avoid a closure and liquidation. But in these cases of these 22 institutions, they were extremely small. They really didn't have any franchise value. We couldn't find any acquirers. And a lot of them were 90 to 95% of the deposits were all insured anyways. So it just worked out that the best way to get them out of the system was a closure or liquidation. And in the recoveries, there was a very high recovery rate over time. So it was viewed as less costly. Typically, it's the supervisor that takes control of a failed bank and moves towards a winding up order. But CDIC has also been provided winding up powers under certain conditions. Key resolution tools, we think this is a pretty wide list. Everything from liquidation and payout to bail-in, bridge institutions, assisted transactions. The biggest failure CDIC ever dealt with was Central Guarantee Trust in 1992. At that time, it was about a $15 billion institution, quite a sizable institution, and a assisted transaction was utilized in that case. So that was the biggest one that they had to deal with. One of the interesting things that CDIC and its supervisor have developed is because as a loss minimizer, CDIC also has some intervention powers. This issue of overlap and duplication became a challenge in some of the bank failures in the 90s. And there was issues with communicating information about one entity not being clear about its roles and objectives. And so we developed this guide to intervention, which explains in a number of cases and scenarios what is the role of the supervisor in a problem bank, what is the role of the insurer. And typically the way it works is if there are no problems in an institution, you really don't see CDIC. And CDIC really just collects information. But as you go down the slippery slope, as you move from a no problems to an early warning, CDIC's role increases. So by the time you get to, say, a stage 2, where you have risk to financial viability, there's a lot of things going on with that institution, a lot of reporting, the supervisors making requirements on that institutions and undertakings, and CDIC is working very closely with the supervisor so that when you get to stage 3 and 4, that's basically CDIC taking over a lot of that role from the supervisor. Once an institution is deemed to be, its future financial viability is in serious doubt, 9 times out of 10 it doesn't recover, it's moving into non-viability, and that's when CDIC effectively sort of takes over and then reports to the supervisor on what it's doing into the Department of Finance. So this was a very, very useful tool, and we found in a system, particularly where you have a deposit insurer with a wider mandate and you want to make sure everything's well coordinated with the supervisor. So it's something that's been very useful. CDIC is also a systemic bank resolution authority, so it requires by law resolution plans from all the banks, and in particular the systemic banks. CDIC has to conduct resolvability assessments of banks. They're now on their, I think, fifth generation of resolution plans. And they run a crisis management group for Royal Bank, and they're also a member of HSBC's crisis management group. So they've been very busy with this the last few years, and this is quite a task for an insurer resolution authority, is to set up a resolution planning framework. Some of these resolution plans are absolutely huge. Royal Banks is about 700 pages. They have over 200 legal entities, and CDIC has really taken on a new role doing this, and they've been working very closely with OSFI, the supervisor that does the recovery plans. This has also required CDIC to do a lot of MOUs because these global systemically important banks have a lot of operations, and simulations. When CDIC had a lot of small failures, nobody did any simulations because you didn't need to. You were dealing with them on quite a regular basis. But over time, when you don't have failures and you don't have any way to practice, you have to develop tabletops and simulations. And these range from payout ones, they did a number of payout ones in 2015 and 16, to much more elaborate simulations of a systemic bank failure. And this has really been the last 2 years what I've been told they've been concentrating on extensively. They've done simulations involving staff and also involving the board of directors. Because one of the interesting things when you have failures is if you have a board that hasn't dealt with a bank failure in a long time, they're not sure of their roles and responsibilities. So it was an interesting education process for the board members to find out the types of decisions they'd be expected to make and what they were expected to do. I'm getting near the end here. Funding, CDIC is an ex-ante funded system. They have a 100 basis point or 1% of insured deposits target. Currently, they have about $5 billion in the fund, but very importantly, they have emergency liquidity assistance. It's written within the Act. They can borrow up to $23 billion from the Federal Department of Finance, but that must be repaid with interest. That's the key. It's liquidity. It's not a grant. And they can get emergency liquidity assistance from the Bank of Canada. This is really designed for the systemic banks. But what's interesting about this is most lender of last resort you get from a central bank, it's for an illiquid but solvent bank. And that creates issues in dealing with systemic banks. So in the Canadian case, what they've done is they've allowed emergency liquidity assistance from the Bank of Canada when there's collateral, but in cases where there is a viable resolution plan. So if there are questions of insolvency, but there's a viable resolution plan, then that liquidity can be provided. They have a differential premium system in CDIC. It's been there since 1999, and they've got 4 premium categories. Low-risk members pay 7.5 basis points. High-risk members pay 33.3. It is a totally transparent system. Over half the indicators are quantitative and publicly available. And the only thing there that causes some issues is we use the supervisor's rating. And that is known to the banks, but it's not disclosed publicly. So this is, I think, one of their great achievements was this relatively well-balanced differential premium system. It's been refined a few times, and I'm sure my colleagues would be happy to share with you if you want more. These are just some of the key success factors for loss minimizers. Given the breadth of their role, they need a lot of clarity in their mandate, and a lot of very high-level information sharing and coordination goes on. So this needs to be extremely well documented and formalized in MOUs, in financial stability committees. As you get more and more responsibilities, coordination becomes more and more important. You need an ability to conduct some type of risk assessment. You have to determine a least cost resolution, so you have to have those tools. Contingency planning and crisis preparedness. When you have a very significant role in large bank resolution, this becomes systemic territory. So you need to be part of the central bank, supervisor, Department of Finance, safety net partnership, wide range of resolution tools, access to sufficient funding we talked about, and last but very much not the least, operational independence. And it is critical for all deposit insurers, but even more so for a loss minimizer. And I should also add as well that it's important to be independent, but you've also got to be accountable. They both go together. And with that, I'll close. Thank you.
Thank you very much, David. Like I said earlier on, this is the final, and in the final you are allowed injury time. So I will not take much of your time. I will immediately call upon Emelo Osuji to make a presentation. Thank you.
Okay, let me start before the slides are up. Probably we'll have to do what Wilbur did yesterday. It's like the launch is acting on us somehow, some people. So we are free to do the exercise as we've learned. Do the shaking if you know you are sleepy. Oh, some people are even doing that. That's fine. It keeps you awake. Just stretch. He's here to teach us, right? because the launch is working somehow. Yeah? Good. Okay. Okay, good. Oh, that's good. Thank you very much. I think we're more awake now. Okay, my name is Emily Osuji. I am going to talk about NDIC, really. First of all, I want to thank the organizers because you can see that the papers are actually flowing. Yesterday, we talked much on the fundamentals. Today, we are dealing with the cases, the case studies for each country. We're listening to Tanzania, we're listening to Kosovo, we've just gone through with Canada, and this is just NDIC. In fact, from the way the topic was given, it's like, what is the case study? NDIC, mandate and powers. But we have to link it to NDIC's contribution to the financial sector, the financial stability of the economy of Nigeria. So we have some outlines. By way of introduction, we have 30 minutes. I just hope we'll get through 30 minutes. And then the rationale for establishing NDIC, the ownership structure, and the functions. The design features of DIS in Nigeria, the mandate as risk minimizer, that's what NDIC is. And then interagency collaboration, which works very well in Nigeria, our contribution, and then some few challenges, and will be true. Well, some of the statements there have been said and said again. A stable banking system, we know, will have to strive if various initiatives are implemented just to help it. For us, one of such initiatives was the establishment of NDIC. It was, of course, to curtail disruptions that typically follow bank failures. The history of Nigeria shows that economic crises really tend to follow financial crisis. The deposit insurance system, of course, we all know that established to protect depositors against the loss of their insured deposits, especially the innocent ones, the uninformed ones, those that can't read and write, but they have their monies in the banks. For our safety net, this is what is obtainable in Nigeria. We have the 3 pillars: regulation and supervision, which is carried out by both NDIC and CBN jointly, Central Bank of Nigeria. We have the resolution, the lender of last resort, which is solely performed by Central Bank of Nigeria. And then we have the deposit insurance system, which is performed by NDIC, the corporation itself. These 3 pillars, of course, merge to give a very strong and robust banking system in Nigeria as we have it today. Of course, it culminates to financial stability, and when you have a stable financial system, the depositors are more comfortable. The history, rationale for deposit insurance system in Nigeria, the history starts from a committee, actually. Central Bank set up a committee in 1983 by the board of Central Bank to examine the operations of the banking system in Nigeria. Just a simple function. But that committee came up with a recommendation that there should be a deposit protection fund in Nigeria. Consequently, the Nigeria Deposit Insurance Corporation was established through the Decree 22 of 1988. Then we were under the military rule, so it was called the decree. By the operation of the NDIC did not start till March of 1989. This was part of the economic reforms in the 1980s taken by the then government to strengthen the safety net for the banking sector following liberalization. Anybody that knows the history of the economy of Nigeria will know that in 1986 there was a liberalization which led to central bank issuing banking licenses to various banks came up, and that brought a lot of competition in the economy. Meanwhile, that period was a period of structural adjustment seriously in the economy of Nigeria then. So this deregulation led to liberalization. Many people came into play in the banking sector. And of course, you know what resulted in that: stiff competition, some unholy practices by those banks, and that led to failures of many of the banks. So the regulation under the Structural Adjustment Program and the liberalization led to the increase in number from 42 banks in 1986 to 107 in 1990, and then to 120 in 1992. The increase in number of banks as a result of this same liberalization, of course, I've said that, led to a lot of competition, both holy and unholy ones. And then we had the failures. So ADIS with supervisory powers over the banks was considered very necessary at that point to complement the CBN effort. So the establishment of ADIS was to protect the depositors in Nigeria at that point, especially the small savers. The deregulation, anyway, of these banks and the significant increase in their numbers, as I said, led to so many things. You know that Nigerian economy, banks play so much important roles. So the NDIC was created through the decree of 1988, and that decree was repealed in 2006. That's when we had our act, and there were a lot of amendments from the original decree. NDIC is an autonomous agency of government established to administer deposit insurance scheme in Nigeria solely. It is wholly owned by the government of Nigeria through the central bank in this ratio of 60% shares and the Federal Ministry of Finance. I know that there are some deviation from what we've had from some jurisdictions. So this is how the ownership of NDIC is 60% central bank and 40% Federal Ministry of Finance. Our operations commenced in 1989, and yours truly was opportune to be one of the pioneers. So I've been there since 1989, its inception. That's 30 years. We are planning for our 30-year celebration now. Section 2 of NDIC Act 2006 stipulates the following functions. When you want to look at the NDIC function, we look at it through our act. And that's ensuring all deposit liabilities of licensed banks and such other deposit-taking financial institutions operating in Nigeria to engender confidence in the banking system. We give assistance in the interest of depositors and also to avoid damages to public confidence in banking system. We guarantee payments of depositors in case of imminent or actual suspension of payments by insured financial institutions up to a maximum insured amount. I will show you that later. We assist the monetary authorities in the formulation of and the implementation of banking policies to ensure sound banking practice and fair competition among banks operating in Nigeria. Of course, with every other measure that will come up that is not repugnant to our objectives. For membership, participation in the scheme is compulsory for all licensed banks and other deposits taking financial institutions in Nigeria. So we have 3 categories. I had David talking about trust, and I had yesterday he was talking about members union and credit unions and all that. So probably different jurisdictions have different names for different banking levels. For us in Nigeria, we have the conventional banks that we call Deposit Money Bank, DMBs. We have the PMBs, the primary mortgage banks. And then we have the non-interest banks, and we also have the microfinance banks. These are all covered by the scheme in Nigeria. And we have the coverage, the deposit money banks, the non-interest banks, and the primary mortgage banks, 500,000. This was not from inception. I'll also show you when the increase. Someone spoke about gradual increase. I think NDIC had followed that. There has been some increases that brought us to this amount. For the MFBs, it's 200,000 naira. The funding sources. NDIC capitalization, the initial capital, as I said, 60% central bank, 40% Ministry of Finance. That made up the 100% capital, initial capital, and every other fund from assessed premium by participating institutions. And I would like to say that NDIC does not, I was explaining to someone yesterday that NDIC does not use the DIF to run its operations. Rather, we use the profit that comes from the investment of those funds. And NDIC, by law, is not allowed to invest in any bank for now, except the Central Bank of Nigeria. So we have income from these investments, and that's what funds the operations of the corporation. Well, Act allows for borrowing. I don't think we have gotten to that stage of borrowing yet. The funding ex ante typically comprises, like we've had yesterday and today, initial capital subscription and then premium collection. Of course, this ensures availability of funds to meet the insurer's obligation. Ex post does not guarantee that. So if you look at what David also presented, you could see the difference. Premium payable by all licensed banks in Nigeria. So they pay premium. The deposit money banks and the primary mortgage banks are now assessed through the DPAS, the Differential Premium Assessment System. But we still use the flat rate for the microfinance banks. They are so large, we have, as at December 2018, we had about 1,000 microfinance banks operating in Nigeria, so huge. And anybody who knows the technicalities involved in differential premium assessment will know it's so much job to be done. But very soon, we are very close to also introducing that for microfinance banks. We all know the advantage and the disadvantage. The banks are really very happy with the differential premium system because the riskier you get, the more premium you pay. When we were operating under the flat rate, many of them were under that cover of the percentage. But for now, many of them are happy, especially those that feel they are less risky. So the less risky you are, the less premium you pay. Deposit protection, the implicit, it has no formal system in place, no formal means of funding, no commitments. We all have those qualities. But the explicit, of course, we know, is established by legislation. It spells out the mandate, the powers, the governance, the structure. There are rules and there are regulations guiding participation in these institutions, funding arrangements, coverage, compensation limits, everything, failure resolution. reimbursement of depositors, they are all embedded in an explicit DIS. A pay box mandate we had from Kosovo this morning, and pay box plus we had from Tanzania this afternoon. So I don't need to go through that. What it is, we all know. Loss minimizer, we just got through with David, but ours is risk minimizer. We have the power of a pay box plus, and with other responsibilities for supervision, for enforcement and prompt corrective actions. We have the full suite of early intervention and resolution powers, as well as prudential oversight responsibilities. We have the powers to set regulations and undertake their enforcement through supervision and failure resolution activities. Our laws permit us to do that, our act. NDIC's mandate as a risk minimizer will have the banking supervision. NDIC supervises banks to protect depositors, to ensure the monetary stability of the economy, to promote an effective payment system, and promote competition and innovation in the system. Supervision is undertaken to minimize the risk of failure of insured institutions and to ensure that unsafe and unsound practices are curtailed. In NDIC, we have two levels of supervision: the on-site supervision, where our examiners go out to the banks to examine, and then we have the off-site. A little bit of it was said yesterday. The off-site, we call them the analysts. They are the ones that analyze the returns from the banks. They look at the banks, and they go on examination also once a year to those banks, just to look at the books, try and see if the returns that were transmitted were actually what is on record and all that. So we have these two big departments. So NDIC also, of course, have cited risk-based supervision. When we started in 1989, and a few years thereafter, we were using the normal checking of what we call the conventional examination, traditional way of examining the banks. But thereafter, the risk-based supervision was introduced in collaboration with our central bank anyway. There is zero tolerance for unethical practices in insured institutions. This we work out with the Central Bank of Nigeria very much. On distress resolution, NDIC is empowered to provide financial and technical assistance to failing institutions in the interest of the depositors. Financial assistance could be in form of loans, guarantees, or accommodation bills, or what we call accommodation facilities. Technical assistance may be by assumption of control and management, assisted merger with other viable institutions. NDIC and CBN handle distress resolution jointly. Various resolution options have been adopted over the years to manage distress. For the first step, they are in stages, depending on how bad that institution is. But the first thing NDIC does, of course, in collaboration with Central Bank, is to look at what we call an assistance by either changing the management or what we call the holding response. Will stop you from granting further loans. You try to look at your books and make your recoveries, and under the holding action, you can also change the management, which is the last thing, or you can stop them from further projects. A lot of things under the holding action, just to make sure they are checkmated. Some, we go to the extent of even rationalizing the branches and probably the staff. But if all these things were taken care of and the bank couldn't still survive, then you go to the next stage and you go to the next stage. So we have part of it, the open bank assistance. We have the purchase and assumption, which someone has also spoken about. These have all been practiced under our jurisdiction, including the bridge bank. lately also. That's actually the last one that took place this year. One of the big banks under the Bridge Bank was taken over. For liquidation, Section 28 of our Act 16 of 2006, as amended, states that the corporation shall be appointed as the liquidator of a failed insured institution. I was telling someone that in Nigeria, NDIC is the only corporation that is appointed as a liquidator, at least for now. That's what our Act provides. So if a bank is down and is to be closed, NDIC, CBN will withdraw the license because they are actually the ones that issue the license. And once they withdraw the license, then they will appoint NDIC as liquidator with all the legal links that has to go with it. So bank liquidation is always adopted by the corporation and CBN as a last option after all other resolution options have failed. The liquidation process commences with an orderly and efficient closure of failed institutions to ensure that there is little or no disruption to the banking system. We ensure that it's cost-effective in realizing the assets of these closed banks and then settle the claims that's uninsured in priority, first insured, then the uninsured, then the creditors, and then the shareholders in that order. Payment to depositors are given priority over every other creditor in the liquidation process. Then interagency collaboration, much of this has been said. It is very, very important. There are three components which we met in my earlier slides: the safety net, lender of last resort function performed by the central bank, then the deposit insurance performed by our corporation, then the supervision, which is performed by both CBN and NDIC jointly. While NDIC is responsible for the deposit insurance, the CBN handles the lender of last resort. Both institutions cooperate through off-site supervision, joint on-site examination, or exchange of bank reports where these are separately conducted. For now, for the deposit money banks in Nigeria, the examination, on-site examination, is jointly performed by CBN and NDIC. But for the primary mortgage banks, the Special Insured Institution Department of NDIC and the other financial institution department of Central Bank both departments handle the microfinance banks and the primary mortgage banks. What we do at the end of every year, CBN lists out some banks, and those banks will be examined by NDIC, while the other remaining banks will be examined by them. But every bank that is examined, the final report is exchanged. So as we speak, every bank examination for these two categories of banks performed by CBN, we have the reports. And all the ones we also have, they have the reports. So you can call for the report of every bank. But each bank is examined just once in a year because there are very, very many, just once a year. So efforts are usually being made to make sure that you don't omit any bank in a particular year. So you have a 12-calendar report. By the other year, the banks, the CBN or NDIC will come. Another thing to note is that the same bank, the bank NDIC examines this year, CBN will examine it next year. So you have 2 years before you can get into that bank. So there is so much collaboration between NDIC and Central Bank. The two institutions jointly developed what we call the IFAS, the Web-Enabled Financial Analysis and Surveillance System. This is a system through which the banks send in their returns, quarterly, half-yearly, or end-of-year reports. But this system is being enhanced by a new system that is being developed now called the Integrated Regulatory Solution that will replace the IFAS. There are so many advantages And the IFAS have been used over the years, so it has to be enhanced. So the IRS is actually an enhanced system for collating the returns and information from the banks. Both institutions also collaborate on several bilateral committees. NDIC has, since its establishment, participated actively and in several international exchanges, among other deposit insurance systems. I'm sure our sister and our neighboring countries will attest to that. The corporation also participates actively in what we have a body called the Financial Services Regulation Coordinating Committee. Every regulator under the financial system in Nigeria belongs to that group. They are active members. Of course, we are in IADI, both regional and international. We also belong to the Islamic Financial Services Board. When I mentioned the categories of banks in my earlier slides, I also pointed out that there is non-interest banks. We have them in Nigeria now. So we belong to that board. Of course, the Committee of African Bank Supervisors, and then the Bankers Committee. Someone was asking me, what committee, how do we interact with the central bank? And I was also asked that question, whether we have a representative of the banks on our board. No, we don't. The Bankers Committee is a committee chaired by the Governor of Central Bank, and it has all the managing directors of the deposit money banks as members, and NDIC is also part of that committee. We have a body that supervises the microfinance banks. It's called National Association of Microfinance Banks in Nigeria. We do so much with them just to make sure that sector, there is sanity in that sector. We also participate in that of the mortgage banks, primary mortgage banks. That's called the Committee of Mortgage Institutions in Nigeria. So NDIC, one way or the other, belongs to all this, just to make sure information is disseminated rightfully too. Under the deposit guarantee, all depositor funds in licensed deposit-taking financial institutions in Nigeria are guaranteed by the NDIC in the event of failure. Then increased deposit coverage. When we started in 1989, the coverage was just 50,000. And if you multiply that with even the present rate, let's say $360 Naira per dollar, you can see it's so meager. That was in 1989, and it went on for some years. It was increased to 200,000 in 2006, and then to 500,000, what it is now in 2011. So any bank that failed between 2011 and now, for deposit money banks, could have gotten 500,000. And the MFBs, the microfinance banks, are still 100,000. But their own payment commenced in 2006 with 100,000, but now it was increased to 200,000 in 2011. So I want to say something here. The increase, at any point in time, there is always a research. And that research is undertaken to know the level of coverage. So these increases were not just automatic. They are proven from these researches that were conducted. So we have now added the mobile money operators, and theirs is also 500,000. For bank supervision, of course, this is undertaken to minimize failure and threats to the IADI. I've talked about the IRS, and for microfinance bank, their system, just as we have the IRS, the microfinance bank, CBN and NDIC is jointly developing what we call the NAMBWIT. And the NAMBWIT, that's the National Association of Microfinance Banks Unified IT Platform, just to assist also in collating their returns. For distress resolution, we've talked about holding actions, open bank assistance, I just want to mention that in 1989, 10 banks were assisted under the accommodation bill, which cost NDIC 2.3 billion. Of course, in between 1999 and 2000, 7 different banks were acquired, restructured, and sold. We took over 28 banks between 1991 and 1996. I told someone during our discussion that in 1998, in one day, NDIC closed 25 deposit money banks. In one day. We were all over the country. And it was smooth. There was no disruption in the financial system. And that is as far back as 1998. Okay. We've done purchase and assumption. I have to rush. We did that first in 2006. For anybody that is familiar with NDIC and the economy of Nigeria, we know that there was a Soludo consolidation. Soludo was the central bank governor and felt that the capital of the banks should be increased. And of course, when you do that, some of them will not meet up that. And there were fallouts from that consolidation. And that's actually when we practiced purchase and assumption for the first time, because the existing banks were asked to come and cherry pick the assets and liabilities of those banks. So we had a brick bank. Of course, our act provides that in section 39, and that was introduced for the first time in 2011. Bank liquidation. NDIC has successfully closed 49 banks, 49 deposit money banks, and 340 microfinance banks, and 50 primary mortgage banks since inception. For dividend, they are in billions. We have declared over 12 billion dividend in favor of uninsured this time around, uninsured credit depositors of 34 banks that failed before that consolidation. Of course, we have realized assets with all the difficulties of realizing the assets of these banks. We have paid 100% to 17 banks. What it means, after the insured deposit, depositors of 17 banks have gotten their money full. We have also paid up to some shareholders of about 3 banks have also gotten money, because the money realized is not NDIC's money. So as we pay depositors, pay creditors, the balance we pay the shareholders. It takes time, but we have done that for 3 banks now. Other contributions of NDIC, financial literacy, very close to the heart of the management of NDIC, financial literacy. There has been so much done in that area. Sponsoring the Financial Literacy Steering Committee, we are part of it. And then in schools now, some schools have the curriculum of deposit insurance, some universities, and some secondary schools, And the teachers, there are a lot of trainings going on in this area, because we've been talking about public awareness of DIS. It's a different story altogether, but a lot of efforts have to be made in this regard. I want to talk about the challenges of NDIC. Just few legal challenges. There are so many of them, as I'm sure you may have been experiencing in your own jurisdiction. Since inception, the corporation has faced legal challenges in the course of performing this particular statutory function. And then the corporation pushed for a repeal of 1988 decree, and we got the Act of 2006. We are also at the National Assembly for now, trying to amend the Act for 2006. We haven't succeeded yet. The weak corporate governance in these banks, they are a worry to NDIC. We have so much insider abuses for the banks so far closed. We keep emphasizing on KYC. I don't know how much of it the banks are, carrying out. You find out that you are stuck when you have to liquidate. though a final comfort, but when you close, how fast do you realize the assets of these banks? The challenges encountered by the corporation included legal impediments, asset stripping, because NDIC can only go into a bank to liquidate when CBN withdraws the license. Over time, these banks are bad, and they are being managed by NDIC CBN, and a lot of things are going on that could be asset stripping in between. We have also software problems. Some of these banks, they don't have the sophisticated software, so during closing, you have some difficulties. In Nigeria today, if you don't have the statement of account, which is one of the prerequisites for you to present if you take a debtor to court, but some of these banks that were closed, you can't print their statement of account because the systems are down. Probably before the banks were closed or liquidated, the software they have, the licenses expired. Some of them were outdated systems and all that. So we have those challenges. And then the cost in closing. The closing cost is escalating by the day. The judicial process, I don't want to delve into that so much. It's a problem. But NDIC, we have trainings for our judges. It's part of the legal department's budget, just to educate them, because some of them are not deep when it comes to liquidation laws. So NDIC undertakes to train them, give them seminars and all that during each year. It features so much in the budget. And then, of course, the judges have to go for their recess. You find out that the cases are adjourned. Before you attend to a court, 2-3 months, they are also adjourned, long adjournments. And we are still in court, even with some debtors of banks that were closed as far back as 1998. Some of their cases are still existing. Well, my ED spoke about the reimbursement period. We were trying to maintain the 90 days. We've upped it to 30 days now. The 7 days I've been discussing with some of the participants. It's so Herculean. I don't know how we can achieve that for now, maybe in the future. And because we are pushing for 30 days, and the best practice is 7 days. But I know we'll get there. Inability of some banks to send complete returns, even as electronic as they are expected to send their returns. Some of the returns may not be factual, as you discover, and then you have to battle with it. Some of them, especially the microfinance banks, don't even have, some in the remote areas don't even have access to transmit their returns electronically, and it's a challenge. Of course, poor asset quality, inadequate risk management practices. When you go into the reports of these banks, you find out that some of them are not actually doing the real thing. I've talked about poor rendition of public awareness. Much has been said about that, and I won't go into that so much, but it is a problem. NDIC, in this regard, is doing so much. We go through the local languages. Management have times, on the electronic media just to educate the populace on DIS. We have also participation at trade fairs. The different states organize trade fairs, and NDIC will always have a stand there just to talk to people about this. We also do jingles so much. Jingles on radio station in local languages to educate depositors. So many things are usually being done. I may not enumerate all of them here. We have, of course, some of us don't even, some of the populace don't even know that NDIC exists. So we have a problem. We have to go through all this just to bring them to know that their deposits are insured if anything happens. Well, I want to conclude by saying the capacity of the DIS to contribute to any financial system depends on the design features, such as the mandates and the powers, as we've been seeing all since yesterday, the funding, the coverage, the oversight functions, the intervention and resolution functions. A broad mandate supported with operational independence enhances DIS ability to contribute effectively to financial system stability. Similarly, adequate funding and flexibility to access or to call upon a wide range of stabilization tools, such as authority to increase level of coverage, which our board now has. When we started, we didn't have that, but now our board they have the power to increase coverage. Would enable deposit insurers to react quickly to rapidly changing circumstances, which are capable of threatening the stability of that system. NDIC has put in place various measures to protect the economy from the risk of deposit runs, and thus contributes to the stability of that system. Apart from ensuring deposit liabilities of all the banks, the establishment of NDIC has no doubt generated the required stability and confidence through its activities in the Nigerian financial system. The importance of interagency collaboration cannot be emphasized. Very, very key, very, very important in the achievement of the financial system stability. I think I want to thank you for listening.
Thank you very much, Emily. I think one of the key attributes of a deposit insurer that is not added in the core principles is patience. So thank you very much for being patient. My apologies that I've eaten into your question time. But I think for those that have pending questions, this is the time to ask those questions. And if you don't have a chance to ask any questions in this session, the presenters are still available. You can chat to them after the session. So I open the floor to any questions that anyone has got. We'll take 3 questions at a time. Yes, Board Chairman.
Thank you, Mr. Vuma. Mine is addressed to both David and Emily. They are very short questions. Emily, the NDIC, the experience is quite phenomenal. I hope all this is documented, and I don't know whether you can share your unique stories with all of us so that we can read and maybe we don't repeat the same mistakes and we learn from you. You talked of approval of revocation of terminally distressed financial institutions as a challenge. You request approval from who?
Central Bank of Nigeria.
Oh, it is the Central Bank.
They withdraw the license and they appoint NDIC.
I see.
Yeah.
Okay, this is also relatively related to what David mentioned, that actively managing exposure to higher risk members. Then you talked of revoking the license. What are the implications of terminating membership of the paying institutions? And what is the effect on public confidence? Wouldn't you get a run on the financial institutions because they are no longer your members? And when they are not your members, it means they are not contributing. And if news goes out to the public, what happens at that point in time if they continue running?
Thank you, Mr. Vuma. I'm called Roy from Uganda. Thank you, dear speakers. My question is also general to both speakers. I want to seek clarity whether the mandates of these insurance deposit systems, the mandates that have been mentioned throughout today, are exclusive, or deposit insurance fund can adopt both at the same time for purposes of legislation. especially at the inceptive stages, or they are strictly exclusive, that you cannot take on one and the other at the same time? Thank you.
Thank you very much, Mr. Moderator. I just first want to inquire whether the rules of the game remain the same, where you ask one question and wait for a second round, or you can ask all your questions and finish with it once and for all. I have two questions.
I think let's finish with you once and for all.
Okay, that's fine. So thank you very much. I just want to find out, in your deliberation for the person from Nigeria, Emily, I understand that the ownership of NDIC, 60% is CBN, 40% Ministry of Finance. That's quite clear. Then along the way, I also understand she said they sometimes embark on borrowing. I was wondering, borrowing for what, on what terms and conditions, and what kind of collaterals will be used to borrow funds in the name of NDIC. I'm happy that she said they are restricted from investing the funds in any commercial bank. They can only put it in government securities and at the central bank. That's quite fine. But I am trying to figure out under what circumstances would you need to borrow? And if you are to borrow, under what conditions and what kind of collaterals would you be embarking upon locking people's funds? Because if you mobilize from banks premium, you go ahead to borrow from people, you are running similar characteristics with banking. So I would want her to throw some little bit of light on that. Also, the last one, she said they are the liquidator in Nigeria. You know, back home, when we are embarked on liquidation, we either take professional accountants to be liquidator, or we take lawyers. So is it that NDIC is staffed on multidisciplinary basis, where you have accountants, you have lawyers, you have all kinds of people there, or you still handle it in your normal central banking way? I just want some enlightenment on that. Thank you.
I think especially answered with the structure. If you're a pay box, if you're a risk minimizer or you're a loss minimizer, you have, I would say it's a kind of graduation. If you're in one system, you're in one system. But if you look at what was presented, you find out that for a risk minimizer, every quality of a loss minimizer is embedded. But for a loss minimizer, there are some skeletal characteristics or fundamentals that they don't perform. So if we look at the two papers, you'll find out that for NDIC as a risk minimizer, it's comprehensive, the activities are comprehensive. Supervision, liquidation, and resolution, and every other thing. So if you are in one particular system, one mandate and power, you are within that. I don't know if I'm clear. You understand that? Okay. Then for Amodu, I think I did not say that we borrow. NDIC, we don't borrow. I said there's a provision in our act, but we don't borrow. Yes, so maybe you didn't get it very well. That's your first question. We don't borrow. But your second question, NDIC, as I said, even in that 1998, when 25 banks were closed in one day, we did not use accountants, external people. We were almost at the verge of doing that because it was enormous, but it wasn't. In NDIC, we have accountants, we have lawyers, we have multidisciplinary. Well, because of time, I didn't present the structure of the departments. You will see that we have all this. Even when we closed the 158 microfinance banks last year, it was also done by just NDIC staff. We have about 8 zonal offices. So if you come to Nigeria, the head office is in Abuja. We have the office in Lagos, which is basically operation departments in Lagos. Then we have the zonal offices located at what we call the geographical locations. Nigeria is divided into that geographical. So we have about 8 zonal offices, and they carry out all they help in the bank examination. They also do every other administrative job given to them. So they are full zones and they are operational. So we haven't involved external people apart from NDIC staff in our liquidation assignment so far. Does that answer your question? Okay.
And I think maybe I'll follow from Emily's answer on exclusivity of mandates. I think she's absolutely right.
Okay.
It's difficult to move from one mandate to the other because they often are legal. And if you have a system where you activate some powers and not others, I think it's quite confusing. I'll speak as CDIC as a loss minimizer. The major difference they'd have with a risk minimizer is CDIC doesn't have its own supervisory staff. They would use as an agent the supervisor, OSFI. OSFI acts as their agent, and the provincial supervisors act as their agent. And they did that because of a resource issue in Canada at the time. They didn't want to replicate the supervisory staff. The other interesting thing is, as a loss minimizer, CDIC can actually act as a liquidator and receiver, but it chooses not to, again, because of resources. The liquidation task is actually done by private accounting firms, although CDIC plays a major role in it. It's interesting to see sometimes the difference between a loss minimizer and a risk minimizer, and sometimes it's resources, it's the way the system is designed.